But what if you could become your own bank and now you get to be the one that earns money on your money, right? Because the banks are earning more on our money than we are. So why not recapture the interest that we were previously allowing the banks to make on our money and build that into our own compound interest curve? And so that's the idea, that's the concept, that's the strategy of becoming your own banker.
Hey everybody, welcome back to the Workergenix Mastermind Podcast. Today we have special guest Neal with Infinity Investment Strategies. She's here to talk about something that is special to me. We've been using it in our family and businesses, and I'm really excited for her to share it with you guys. It's a really cool tool, and not a lot of people know about it. So a little bit about Erica. She began her career in finance at a large investment firm where she quickly realized traditional finance planning wasn't designed to meet the needs of business owners. Seeking better solutions, she joined a boutique firm and adopted innovative strategies like the infinite banking concept to help protect their assets and optimize their cash flow and increase liquidity. Now, as co-founder of Infinity Investment Strategies, Erica helps empower business owners to improve their financial strategies, grow their wealth, and reduce their taxes while taking control of their cash flow. Today, she's going to share how you can build, protect, and leverage your assets to fuel your business success. Erica, welcome to the podcast. How are you doing today?
I'm doing well, Harley. Thank you. I'm excited to be on.
What is this infinite banking strategy? That's a really cool term. I think there might be a lot of people out there who are just like, what does that mean?
Yes. Yeah. So it's kind of high level. So, when we talk about the infinite banking concept, the first thing that I really try to impress on people is that that's what this is about. This is a concept. This is an idea. This is a strategy. Instead of keeping money with the traditional banking system, you become the bank yourself and you get to reap all of the benefits of the banking system. So what happens is when you deposit money with a bank, they lend your money out to others and they earn more money on your money than you do. That's how they make their money, which is fine and dandy. But what if you could become your own bank and now you get to be the one that earns money on your money, right? Because the banks are earning more on our money than we are. So why not recapture the interest that we were previously allowing the banks to make on our money and build that into our own compound interest curve? And so that's the idea, that's the concept, that's the strategy of becoming your own banker. And we're using these specially designed cash value life policies as the vehicle to accomplish that. And I emphasize that they are specially designed. This is not like hey, I'm going to walk down to the corner and go get one from my agent. These are very specific. They're very tailored. They're very customized, right? Strategic. We use that word a lot, but it is just the idea of taking ownership, taking control back of your money, that you get to be the banker, you get to make the rules, and most importantly, you get to bring the compound interest that you were previously giving to the banks, and you get to bring that back into your own compound interest curve to help expedite your wealth and expedite your compound interest curve.
Well, that sounds amazing. I know my wife and I have personally used plans like this for a variety of purposes. I'd love to hear some examples maybe of use cases where people are, leveraging these tools in their business and some of the benefits they get from that.
Oh, yeah, absolutely. So the good thing is when we are designing policies, often we are using them as our own personal bank that you can leverage for both business and personal use. So I just preface that because in your question with a couple of examples, I want to look at it from two different fronts. You can look at it from a business perspective. So we have seen it. Actually, we have a group out in, kind of like a rural area, and they are using this to essentially finance their own equipment. So they have built up these policies. And so instead of going to the bank and either putting a lien on their cash in the bank or having to take out a traditional loan, they are actually using these policies, using the cash in their policy, creating a loan from that to go out and purchase their vehicles. Now, the benefit of this, and same thing, we've seen this done with real estate. You can buy a real estate property, or you can just put a down payment on a real estate property. You can passively invest, in like a syndication. I've done it for, I know you guys, same thing, hard money loans, right? I love hard money loans with my infinite banking policy. We've done it. You are the bank, so you can use this for literally anything you want. So on a business side, we actually have a guy out in East Texas who is using this as just a funnel of cash. So he is paying all of his expenses. He's using his policy to pay for payroll, all of the different, software programs, all of his expenses within his business. He's taking money out at the beginning of the month or beginning of the quarter, whatever it kind of falls in, depending on the season. He's using his cash to pay for all of his expenses. And then as the revenue is coming in, throughout the month or throughout the quarter, again, it kind of depends for him, he is using the cash flow and the revenue from that to pay back his policy loan. So the big question that we get is, why would I do that? Why would I loan against my own policy? That's kind of, it seems contradictory. Am I losing something because I'm loaning? Well, here's what happens. We're recreating the banking system. So Harley, if you deposit money with me and I'm your banker, what I do is I pay you very little, right? I pay you maybe 0.2%. And I loan your money out for 7, 8, or 9. So I'm earning a lot more than what I'm paying you, and I'm creating something called arbitrage. So in this concept of infinite banking, right, becoming your own banker, when you become the bank, you recreate that system, but again, it's to your benefit. So what happens is you put money inside of your IBC policy, and when you decide, hey, I want to invest, or I want to buy a business or buy a property, whatever it is that you're wanting to fund this money into, you are going to do it by generating a loan, okay? Because to a bank, a loan is an asset, right? When I loan money to somebody, they're paying me, that's an asset. So when I loan this money out, I'm loaning it and I'm investing in XYZ deal, okay? Now, when you loan against your policy, there is a simple interest rate attached to that loan. So you're paying a simple interest rate on the policy loan. But what happens is you pay simple interest and you loan your money out into XYZ deal. So let's use some numbers. If you have 100,000 in your cash value and you take out a loan for, let's say, 70, you borrow against that 70, you pay simple interest on that 70, and that 70 is getting you whatever rate of return, right? Most of our clients are business owners and real estate investors. They know how to make money. You know how to do what you do. So you invest in whatever deal and you get the rate of return and cash flow that you get, completely up to you. The reason people, entrepreneurs specifically, love to use this policy or use this strategy is even when you take out that 70 and you have it invested, you're still earning compounded interest and dividends on the full $100,000. So you're recreating exactly what Robert Kiyosaki says in giving $1 multiple jobs. And so you're creating arbitrage just like the banks. You're paying a little bit, but you're earning a lot more and you're creating cash flow assets all along the way. So that's really the biggest way in the business world, right? That you're able to continue to use your money, but earn interest on it at the same time while you're funding into your business and while you're funding out to, again, whatever properties or assets that you're wanting to put it into. Now, on the other side of this, so like I mentioned, you can use this for personal. Again, you're the banker, so you make the rules. There's no limitations to where and what you can do with this money. So like my husband and I have used it to put a down payment on our personal residence. We're like, actually right now I'm looking at my next vehicle. I use tax code 179. So we did the 5-year depreciation, all that. So we're coming up on that timeline of getting ready to buy my next vehicle. Right now we're looking at, does it make sense to loan from my policy or take a traditional loan from a bank? Because you can do either way, it's up to you. So we're looking at it for buying a vehicle. I'm also doing it for my children's future education expenses. So I don't do 529 plans anymore. I fund money into my policy, into their policies, because I can use that to help them pay for college. But number one, they may not decide they want to go to college, right? So it's not tied up. Right. I can use it for anything. I can use that money to fund their college, but it won't hurt their chances of getting approved for any, like there's FAFSA, scholarship applications, any of those programs. When you're filling those out, they ask about 401ks, IRAs, bank accounts. They ask about that, and it hurts their chances of getting approved. These policies are private and you do not have to disclose them. So they cannot hurt my children's chances of getting approved for any scholarship programs or things like that if they decide to go to college in the future. So again, simply put, you can use it for business purposes or personal. And the goal of this is you never disrupt your compound interest curve, even when you're putting that money to work in outside assets.
That is a great explanation. Thank you for that. Now, for someone who's getting started, it can be a little kind of overwhelming or confusing of like, the idea of like infinite banking and like, where does the money come initially? Like if someone, let's say they've got 25K that's kind of like in their emergency fund or something like that, and that might be their kind of seed money. What does it look like getting started to get these policies set up and to get to that point where you've got that 100 grand in there that you can use for all these amazing things?
That's a really good point. So one of the things we get that question all the time is, what if I don't have a big chunk of change that I just want to dump into this? And I would say probably 90% of the people we work with are not dumping chunks of money into this, right? It's something where, think about your bank account. How long have you been saving money into a bank, right? Like I think I got my first job at 15, 16, and I've been saving money into that ever since. And I plan to continue to do so. So same thing with this policy. This is not a one and done. This is, like I mentioned, this is a strategy. This is a discipline. This is a way in which we use and view money. And it will be something that we continue to do perpetually throughout our lives. Okay. So coming back to your question, when people are looking at this is how much money I have and how do I get myself to build up to the point of being able to fully finance equipment or tractors or property, you don't start there, right? This is all something that builds up. So what we do is we design a policy based on a minimum and a maximum corridor. Okay. So your minimum is whatever savings level of which you're comfortable. Okay? So something that you know every year, regardless of the economy or COVID or whatever's going on, this is my comfortable savings amount that I want to save into this every single year moving forward. Okay. So the best analogy I can think of with this is like a mortgage payment. You know what your mortgage is, right? Regardless, you know what this is going to be. Now, can you pay over and above your mortgage to build up your equity faster? Absolutely, right?
Absolutely.
Completely up to you. And the good thing is that it's completely optional. You're not obligated to do that. But if you do, you build up equity inside of your property faster. These policies work the exact same way. There is a base premium that you pay, and you're paying for it every single year, a month, however you have that set up. I want to pause for a minute. Most people think, oh, well, base premium, that's just a cost. It's not. And I'll tell you, as you're paying your base premium, just like your mortgage, more and more and more of what you're paying is going to equity as opposed to interest, right, on your mortgage. The same thing goes with your life insurance policy. Every single time you pay your premium, more of that is going to your cash value more than it is the actual cost of your policy. The good news is that it happens much faster than what you see on a mortgage amortization schedule. Okay. Now it depends on person and health and all of that. But the point is, that's the minimum. You pay it every year, and more is going to your cash value. So your base premium does increase your cash value. Now, on top of that, you have the ability to put additional cash. These are what we call like flexible paid up additions, or, FPUR, PUAs, things like that. This is just extra cash. So when people are paying into these policies, what we're looking at is how much cash do you want to put in? How low can we get the minimum? Okay. So we're going to maximize the however much you're wanting to put in on an annual basis. If you say, hey, I want to save X, we're going to get a majority of that to go towards cash immediately. So we have most going to cash. We do have a small base premium. And then every single year, as you're paying, like you said, you're going to stay within that minimum and that maximum, and you can go anywhere in between. And this has been a really big deal, especially over the last couple of years. It's been a little bit rough. So if it's something where you're like, hey, I can't do the full amount that I wanted to do, but I can do the minimum, great. And then what we've also seen, as things start to improve and as your business grows and as real estate grows, you're going to get to a point where you want to put more in. The way that David and I, my business partner and I, design these policies is that as your business grows, as your cash flow and your portfolio, all these things start to grow, we design the policy so that you can increase it and make it bigger and bigger and bigger over time as everything grows. You don't want to start too big. So start at a level that you know you're comfortable. Again, you have the base premium with the ability to overfund, put extra cash in, right, to build up your cash value. But what will happen is you'll have the ability to make that bank bigger as you continually grow and increase in your business.
With these, because they are like insurance policies, the health and age and things can be taken into account. I really like what you said about being able to grow with the business. Now, do people have to worry about like, oh, what if my health deteriorates over time? Are they having to like constantly requalify for these increases, or is that built in from the beginning?
Good question. So within the current policy, if we're just going to expand that policy and make it bigger, there are no new underwriting, no new health questions. Your health is locked in from day one, which is so crucial. So once you lock in your health rating on this policy in the very beginning, if you're making that policy bigger and bigger and bigger in the future, it doesn't matter. Your health stays. It's locked in. You're guaranteed to remain, which is a big deal, right? And that's something that when we're talking about this over the long term, it might take 8-10 years. And I think we can all agree at this point, we have no idea what to expect. I've been caught off guard by health issues, as have many other people we consider generally healthy. So being able to lock that in and not have to undergo any new questions or labs or anything, it's locked in. Now you will also, another question I get is, am I going to have the same policy forever, or can I have multiple policies? You can have multiple policies. And so if you get to that point where you've maxed one out and you want to start a new one, at that point, yeah, they might have additional underwriting required and go through some new information. But what we do is if there is a health issue, we kind of navigate what's the best way to do that, or do you need to be the owner of the policy and use somebody else's physical person as the insured? So there's a lot of strategic ways that we work with people to be able to establish that. We just did one for a business owner. He has a tech company here in Dallas, and he has a couple policies on himself, but he also got key man policies that are owned by the business. So these are two top key employees that he has that if God forbid something were to happen to them, his company would be severely impacted. So he got policies on each of them, funded by the company, owned by the company, but using their physical person. And they're younger guys. So using their physical person. So what happens is they go through the underwriting, the company funds it, and the company gets to use that money for any purpose that they see fit. And then in a worst case scenario, God forbid something were to happen to either of these gentlemen, then the tech company, the owner of the company, would receive the death benefit, and he could use that to help the company stay afloat and go find a replacement for, obviously a key man to their company and not have any disruptions in the business flow.
Well, that's incredible. So that's one thing too that maybe in another area of like real estate investing or people who are like syndicators or they're in a partnership, that key man policy could be a really important thing, not only for just securing their interests or their partner's interests, but if they get investors. Do you have anyone that has worked with you that's like, hey, we want to make sure our investors are comfortable, like the people who are operating this investment get hit by a bus or something happens to them, everyone's going to be made whole?
Oh, businesses, absolutely. Because when you get into the commercial real estate or the syndication space, one of the biggest things they talk about is this isn't just buying real estate. This is running a business, and it should be treated as such. You're running a business. You're not just buying a property as a landlord. So absolutely. We've seen syndications that have used this for those key man type policies. They've even stored cash as a company inside of this to help them leverage through a period of time where, again, like we've seen over the last few years, maybe cash flow isn't as strong. Maybe we don't have those acquisition fees coming down the pipeline like what we've seen in the previous years. So having that money sitting on the sidelines to help leverage through any sort of difficult time, not just to protect against an unforeseen like death, right? Obviously, that's worst case scenario. But in a cash flow crisis, having cash that you can go and leverage and get your company to go through that is incredibly powerful. In fact, real quick fun story, JC Penney. A lot of people have asked, like, why have I never heard of this before? This strategy has been around longer than I think people realize. It dates back to literally the ancient Greeks. But during the Great Depression, JC Penney, obviously they're a retail store. They're not getting any revenue. Nobody's shopping during the Great Depression. So there is a concept called a BOLI-COLI, BOLICOLI, stands for bank-owned life insurance, corporate-owned life insurance. So the largest banks and the largest corporations in the world hold a majority of their assets, their cash inside of these policies. And so JC Penney during the Great Depression took a loan against their corporate-owned life insurance policy. And they used that to pay every single JC Penney employee throughout the entire Great Depression. Like, how powerful is that?
Yeah.
It's huge. It wasn't, and think about it, like the cash value was not affected by the market crash. And when banks were shutting their doors, the insurance companies had plenty of liquidity to fund whatever cash that these JCPenney wanted. And they knew, here's something that a lot of people don't realize. When you take these loans from your policy, you're the borrower and you're the banker. You make the rules. So you get to decide how, when, and if you pay the loans back. It doesn't matter if you pay the loan back in a year or stretch it out over 50 years. And maybe you never pay it back, right? There's a lot of strategies to that too. But the point is, you decide how, when, and if you pay that loan back. So JCPenney paid all their employees, and they knew they did not have to pay the loan back until they could weather that economic storm. Everything started recovering. They started generating revenue again, and they paid that loan back at their own pace. So that's just a really cool, like, historical thing a lot of people don't realize JCPenney was able to do as a business. They were leveraging through that tough time. It's incredibly powerful even today, like I said, with syndicators or other business people who, need a fallback plan.
That's an incredible tool that gives someone a lot of peace of mind, I would imagine. Now, if someone is getting started, let's say this is a new concept to them, but they've been a big saver. They've got a healthy emergency fund for maybe their business and or their personal, and they're like, all right, I want to do this. I want to stop having my money earn 0 point nothing in the bank and start, really leveraging it well with this concept. Do they have a way of like doing a one-time like larger payment than saying like, well, I've just been a big saver for 50 years. I don't necessarily make that much every year that I want to put away in this policy. Is that something that can be structured so they can get it kind of supercharged at the beginning, or do they still have to just build it up over time?
It's going to depend on age. So it's going to depend on a lot of factors, age being one of them. And this is going to sound counterintuitive. Younger people, it is harder to do that. And so a lot of people think, oh, because I'm younger, well, here's the thing. Think about it. When you're younger, your mortality table, your life expectancy is much longer. You have a much longer timeline that the insurance company is working with. So you're putting in X amount of money so you can stretch it out over a longer period of time, which makes it difficult to get a lot of money in early like that. Okay. Versus an older person, their timetable is quite a bit shorter, right? Typically speaking. So because their timetable is shorter, they're able to condense that funding into a shorter timeline. And that's why so many people ask, am I too old to do infinite banking? Absolutely not, right? When we're talking about infinite banking, we're talking about the cash value, not the death benefit. So even an older person, assuming they're healthy, has the ability to get that cash in. In fact, they have a little bit of an edge to get a little bit more cash in. So to answer your question, can we get a lump sum of funding in year one? Yes, possibly we could, but the most efficient and the most effective growth that we've seen is actually doing so at least over a period of a few years, right? Like, 4 to 7 or so is usually where we can see it, just to kickstart the compound interest curve and give your policy enough fuel so that it can self-sustain moving forward. But I'll tell you, I have a lot of people that only want to fund it for, let's say, like 4 or 5 years. And then we get to year 5. And if they put in, let's use 25,000, for example, if they put in 25 and the policy's growing by 35, and they're like, well, why wouldn't I put 25,000 in there, right? Like, if I put in 25 and it grows by 35, how much did it cost me this year? It doesn't. So just kind of, people get to the point where they sound silly, but they look forward to funding their policy and they look forward to putting money into it because, like you said, that compound interest has grown and accumulated so much that now they're getting such a multiplier on their money. It's way better than what they're getting in the bank. So why wouldn't I want to put money in there? But if you do have a lump sum, we'd have to kind of navigate it. It'll be tricky. Most people are putting it on at least a little bit on an ongoing basis.
What is some advice you might tell people when they are starting to look and consider crafting their policy, if they maybe have already been familiar with just traditional life insurance, whether it's term or whole policies, but weren't doing it with the intention of maximizing the cash value to have that double leverage? If they might be seeing different kind of death benefits or terms or things like that, what would you tell them coming into this so that they really understand what they're looking at and able to do an apples to apples comparison?
Yeah, I'll tell you, I had 2 policies prior to ever learning about this. So I did traditional financial advisory for a few years and was taught the whole buy term, invest the difference, and all of the, all of the same old same that's parroted in the industry. But when I learned about this, I ended up having to surrender the 2 policies that I had. I ended up canceling those. There's no such thing as a good tool or a bad tool, right? And Harley, you and I have talked about this. There's no good or bad tool, but if you're trying to cut a piece of wood in half and all you have is a hammer, that's not the right tool for the job, right? That's not going to be done effectively. That's not going to be easy. It's not going to be clean cut, whatever it might be. So I ended up deciding, I'm like, these policies don't work. I'm putting money into something that is not going to perform the job I need it to. And I ended up having to bite it and cancel those policies and walk away. I did get some money out of it, but again, that's a case-by-case basis depending. But to your question, when you're looking at your policy, the first thing is if you have a term, that is not an infinite banking policy. So if you have a term policy that expires after, usually it's 10, 20, 30 years, whatever that given term is, if it expires after that, this is not the infinite banking policy we're referring to. It also needs to accumulate a cash value. So building up cash value inside of your policy is incredibly important. There are a few different types of policies, permanent life insurance policies that build cash value. So it's permanent, not term. So in these permanent policies, the cash value can grow a couple of different ways. You have what's called a VUL, variable universal life. And that means that your cash value is tied to the stock market in some way. So when the market goes up, your cash value goes up. When the market crashes, your cash value crashes. So it is an investment inside of a life insurance vehicle. I do not 100%, I do not use VUL for infinite banking. That's not what it's for. That is an investment and they're kind of expensive. The VUL can actually be very costly because you're paying for the life insurance product and you're paying for all the managed money fees and all the, mutual fund expenses and loads, all of it wrapped into one. So those can be pretty expensive. Yeah. But also think about it. When does most real estate opportunity tend to present itself or business, any buying opportunity? is when the
Yeah, when the
market's
market's
down.
down.
Exactly. So if your cash value is crashing with the market, then that means one, you have less available, and two, you're going to have to lock in losses just to capitalize on that opportunity. Right? That doesn't make sense. So, we don't typically use the VULs. The other option, there's two more. One is the indexed universal life. So, similar to the variable, is that your cash value is tied to the market, but it functions within a range. So you have a floor, usually of 0, maybe 1%. So you have a floor where it can't go lower than that. So you're always going to earn at least, let's say 1%, maybe 2. So you always have a minimum, but then you have a cap on what you're earning. So if the market goes up 15%, maybe you get 8 of that or 10 of that or whatever, right? So you're capped. But if the market crashes, you only go down to earning 0, 1, or 2%, whatever your minimum is. I have used these in the past. I am very, very cautious about using these. Very careful. They look very appealing and they, really attract a lot of people because they can participate in the market without losing. But here's the thing. You know how I mentioned earlier, when you're borrowing against your policy, you're earning more than what you're paying. Okay. So I'm going to give you an example. If you borrow against your policy and let's say you're paying 4.5% on your loan. Okay. Well, if the market's doing 6.5 or 8, great. You have arbitrage, right? Now, let's say that the market crashes. Again, that's the perfect buying opportunity. The market crashes, so you're only earning 1 or 2%, and then you borrow against it to go invest, and now you're paying 4.5 on that loan. That's a negative arbitrage. So we're reducing that. So my point is, on these variable products that fluctuate with the market, we're chasing an investment inside of an asset that's not an investment. We're trying to cut a piece of wood in half with a hammer. Have I used them and do they serve a purpose? Absolutely. We've used them for key man policies. We've used them for business continuity. 100% we can use them, but we're very, very careful about how and why we use them. They also have some long-term concerns as well. They have the ability to, as you get older, and like you mentioned earlier, as you get older, can your health rating change and all that? Within these universal life policies, they can. They have the ability internally to increase your charges, charge you more and all that. So again, we're just kind of not a good or a bad tool, but we're just careful when we approach those that we do them correctly. And then the last one is the whole life. This is granddaddy, right? This is the one that's been around. Like I said, the ancient Greeks, they've had it forever. And this is a policy that has two components. It has a guaranteed growth. So you're getting that guarantee every year. Market crashes, doesn't matter. Market does high, doesn't matter. It's always growing. You also have dividends that are added on top of that guarantee. And the dividends, we're using mutually owned companies, which means we can't buy stock on them. They're privately owned. But because they don't have stockholders or shareholders to pay dividends to, and they don't have an 8-figure CEO, they pay that to the owners, the mutual owners of the company, which are these policyholders. So as a policyholder, you get to benefit in the profitability of the company in the form of a dividend. Are they guaranteed? No. But the companies we use have been around for over 120 years and have paid them every single year since their inception. So take that however you want. I do lean towards the whole life side because of the guarantees. When the market's up, your IBC policy's up. When the market crashes, your IBC policy is still up. I have my investments, I have my volatility, and I have my rate of return outside of my policy in my investments, in my business, in my real estate. Everything that I'm doing in an investment category is outside my policy. Inside my policy, I'm getting that steady eddy growth and compounding interest. I'm not having to worry about anything. I'm just growing and earning every single year. So you want to look at, how is your cash value earning? Are you getting dividends? Are you in an index, or are you completely open and susceptible to the volatility of what the market's doing? Those are the three things you need to look at.
Well, Erica, you've shared a lot of great benefits and strategies here today, as well as, kind of introducing this concept and different options out there. I'm sure a lot of people listening probably have additional questions, and we're going to go ahead and have a link to get connected with you in the podcast description. Everyone can click that. It's going to go to a webpage, and you've got a guide available there. Can you talk a little bit about the guide you have for people?
Absolutely. So this guide that Harley that you're referencing, this is what I call the 4 pillars of infinite banking. So we work at our company, we work specifically with real estate investors, business owners, people in the entrepreneurial space. And the big thing is there's people who understand infinite banking, there's people who understand business and real estate. David and I understand both, and we help people understand, how do you take these two assets within your portfolio and bring them together to maximize what you're already doing. I would never say hey, put your money inside of this life insurance policy. Don't go fund your business. Don't go invest in real estate. That's ridiculous. We are wanting to put money into this policy so you can invest in real estate, so you can go fund your business. And what benefits are you going to receive by putting these two powerhouses together? And that's where the 4 pillars come in. So there's 4 key pillars that when you take infinite banking and plug it into what you're already doing, that you can see benefits of. And the first one, so we talk about lower taxes. So being able to take advantage of depreciation. Infinite banking policies have been called the rich man's Roth. I don't really like that term, but it's all the tax-free benefits. You're able to use your money tax-free, grow it tax-free. You're getting additional write-offs. So when you borrow against your policy and you're paying simple interest, you're able to write that interest off. So there's a lot of tax benefits built into these types of policies. The second pillar is increased control. So I mentioned this a couple of times. You're in control of your money. It doesn't matter who, what, when, where, why. You can go and call and say, hey, Erica, I want to take all my money out and go put it on Black 42 in Vegas. Cool, man. Like, whatever. It's totally up to you. I don't recommend it, but you can access your money anytime for any reason. You get it. Okay. And then, of course, like I mentioned, you have the ability to pay it back at your own pace. It's completely up to you. You also have control over how much you're putting in and when. You have that flexibility of the minimum maximum corridor and the ability to grow it over time. So there's a lot of control that's built into this when it's done correctly. That's key. It has to be built correctly. The third pillar is lower risk. So this is probably my favorite pillar, because we talk about, market crashes and all that, but we really need to be aware of all of the wealth eroding factors that are out there, right? The more money you make, the bigger your target on your back. And we need to be aware of that. So there's a lot of wealth eroding factors we can protect against. Taxes are one of them. The market crashes, I've already talked about that. These policies are protected from that. But also having the cash that's inside of these policies being protected against creditors and predators. So if you have, issues with a creditor, the IRS, you have a lawsuit coming down. Like if you have a clumsy tenant or a clumsy patron who's stumbling on your property or in your business, or I live in DFW, traffic is horrendous. So if I rear end somebody and their neck hurts a little bit too much, they can sue me, my house, my car, my dog, and it completely protected inside of my policy. That cash cannot be sued against. And then the last one is the increased leverage. So pillar 4 is increased leverage, which is being able to access your cash, getting 2 rates of return at the same time, amplifying the returns you're getting on your business, amplifying the returns you're getting on real estate. But you're also able, as a business owner or investor, able to show this. The cash value gets 100% credit on your PFS. So on your personal financial statement, you get to use your cash value as credit towards liquidity and net worth. Lenders love these assets. I was actually just talking to a lender about this, and they're like, absolutely, we love to see life insurance cash value on here because it's easy to access, it's protected, it's tax-free, and it's protected from the market. So this is something that you can either borrow against it and become your own bank, or you can leverage it if you do want to go get traditional financing, and lenders love to see that on your balance sheet. So those are the 4 pillars, and in this PDF, it goes through a lot of details, and we actually talk about there is a cash flow system. Our focus for people is to increase cash flow. So in that PDF, we actually outline how can we recreate the banking system and amplify the cash flow system by putting your infinite banking policy in the middle and creating a flow through account. So we kind of go through all that in that 4 pillars PDF.
Awesome. Thank you for explaining that, Erica. And I want to just kind of throw out to everybody who's listening, not all insurance salespeople or businesses are made equal in regard to infinite banking concept. If this is something that you're interested in, you really need to talk to the right person. There's a lot of people out there who might say that they're familiar with it, or they can, certainly they can do policies when they really just have generic kind of basic insurance policies. They do not cut it. There is a lot of complexity and nuances that go into crafting these. It's really important that you talk to someone like Erica, get in touch with her. She can really do some magic getting these things customized to fit your exact specific needs and maximize the utility of that tool. Like we talked about earlier, you want to make sure you've got the right tool for what you're going after. And not all life insurance policies are the same tool.
That is very, very true. You've got to be careful about the type of policy, the company, the design, the practitioner. I mean, I will say, as one more resource, there's a lot, like Harley, you nailed it right on the head. There's a lot of people, this has been around for a very long time, but it started to rear its head back up. There's a lot of people who are using this as like a marketing tactic, like, oh yeah, you could put money inside of these policies, but it doesn't. If it's not done correctly, again, it won't work very effectively. Of course, if you have questions or want to do infinite banking, myself, my team, we would love to talk to you and walk you through that. If it is not us, however, and you are looking for somebody else, you're like, Erica, hard pass. I don't like her. I want to talk to somebody else. I get it. That's okay. Go to infinitebanking.org and you can find an authorized infinite banking practitioner. So this is infinitebanking.org. This is through the Nelson Nash Institute. This is a license. This is a credit that you can get that actually makes sure that you understand it. There's modules there. You have to do an interview to get into the program. You take the test, you could do, like a proctored exam, and you get your license through the infinitebanking.org system, Nelson Nash Institute. And when you get that, they actually monitor the policies that are put in place by these practitioners. And that helps make sure that they are maintaining the integrity of the strategy. They understand it and they get it, all of that in between. I'm a practitioner. David's a practitioner. So if it is not us that you work with, make sure you go to infinitebanking.org and you find the person that you're wanting to work with and be sure that they're an authorized practitioner. And then also number 2, not only are they a practitioner, but they specialize in the area that you are working in, be it business, real estate. Some people do retirement. Some people do, family planning, whatever it is, be sure that you work with the right person. I always tell people, if you're going to work out with a physical trainer or a personal trainer, would you work out with a personal trainer that wasn't fit? Are they doing what you're doing? And that's what David and I do.
Great advice. Well, Erica, this has been a great conversation. I love the concept of leverage, both with people, finances, system, and this is one of the best possible tools out there for people to get that leverage with finance in their business or their personal net worth building. So thank you again for sharing all your knowledge with us. I encourage everyone listening, please hit that link in the description, fill out the form, get in touch with Erica, and get yourself set up with one of these incredible tools.
Awesome. Thank you, Harley.